All right. Good morning, everybody. So we got a lot of Fed speakers today. It may change the narrative, but I really don't expect it to. Right? Powell's going to try to do the operation Don't Rock the Boat, and the rest of them, I don't want to say they're inconsequential, but yeah, if we were to rank things, they just don't really show up all that high. So it's going to continue to be headlines and whether or not things de-escalate. At 4 o'clock, Iran kept saying they didn't fire any missiles, denies anything at all, and then at 6:20 they're like, "Well, okay, yeah, we did fire some, but it was right before the ceasefire." So Israel's upset about that, and maybe they'll retaliate. We got the president cursing in social media, and I think these headlines are likely going to be more impactful to the market than whatever we get out of Congress today and the other Fed speakers today. Continue to keep your eye on bonds and yields. It's the quiet iceberg that this ship can run into. Small caps up nearly 1%, with the Dow close to 0.75%, S&P 0.75%. The tech NASDAQ at 1%. Europe's up looking good. Japan uh, finally broke under the half. Not yet down to a quarter, but Japan is lagging behind. So today, Powell's in the House. Tomorrow, he's in the Senate. It doesn't list him for tomorrow, but he is the Senate tomorrow. And he's going to do everything he can just to not say anything that rocks the boat, right? It's like Powell 101. Uh, Open his mouth and say a bunch of things that don't mean anything and try not to upset anything and try not to rock the boat. But there's a lot of other Fed speakers from around the world. We've got Bank of England, European Central Bank. I thought there was a Canadian person out speaking today too. There's just a lot of other Fed speakers out there this morning, and even later in the week, we've got more Fed speakers, but all eyes are on the war front. We got the dollar breaking down below 98. So this is something you want to keep your eye on. That's been a line in the sand to keep an eye on for a while now. We could get another dollar out of that thing, at least say down to 97-ish. But um, how fast it moves is often as important as where we find it. So rate of change, it's the same with yields and bonds. It's not always about where they're at, it's how they got there. So keep your eye on the 10-year, 4.3. You know, if we were to break that and start getting down into like 4.0 today, that would be tremendous. 3.8, I think the market would feel it. Overnight volume sitting at 110,000. It's a little higher than what we've seen recently, but you know, if you remember how the year started, we were hitting 200, 400. The norm is less than 80 typically. And so getting into 110 in the overnight, it's not unheard of, right? It's higher than what we'd like to see. We are close to that 6150 call wall, expecting to see it moved and rolled up. And along with that, to see the put wall rolled up. That would be a very bullish behavior to see that begin to unwind. On the other hand, if we see the put wall get rolled down and the call wall not move higher, that would be taken as a bearish indicator. At this point, we're above the volatility trigger, 0 gamma. We don't have enough volatility out there to expect any changes in that front. And it's interesting that we can see all of the levels, right? A lot of times they're so spread apart we can't see anything else. For a while now, we've been focused on this range and how we needed to get a higher high or a lower low. And we got that now. We got the higher high. That does not imply we're just going to keep on going, although that is the base case argument. When we had this range back here, for an example, we needed to set a higher high. We had a really nice gap up, which still hasn't been filled, by the way. And then we just put in some work since then. So there's our breakout. We've closed above. Now we need to keep it. The fact that we even closed above at this point, we're still up there, is a good start. If we don't keep it and we wick back out of it, leaving something behind that looks a lot like this, for an example, it's not going to be good, right? So that's the concern right now for today, is that we end up with a fake break, fast failure. It wouldn't be the first time, and even if we get something like that, like we did here, where we ran up and we fell back down and it looked like a fake break, fast failure, the next day we still ran right back up and closed higher on it. So by itself, just one candle print won't mean much of nothing, right? It's how we follow through with it. But we did get that higher high that we've been looking for. So now we need a higher low. The thing about that higher low is this isn't our pivot high yet. It won't be our pivot high until we fall away from it and leave it behind, so that we can point back to it and say, yeah, we left a pivot high up there, right? Think of it from back here. When that candle formed, all we had is a candle that closed that day. We didn't pull away from it, right? That day right there. And the next day, next day, next day, on and on and on. Until we finally started to pull back, then we were able to point up here and say, hey, we got our higher high. Now, we already knew we were going to get a higher high once we got the breakout. We just didn't know where the pivot was going to form. And we ran all the way up here before it did form. So now we got a breakout. We know we're going to get the higher high. We could pull back after this very first candle, and there would be our pivot. Yeah, kind of Captain Obvious stuff, but for new traders, sometimes the obvious isn't obvious. We made it to the ADR half. Common concept that we talk about if we get to the ADR half early enough in the day is that we can go to the other side by the end of the day. That would be down here. going down to this lower ADR level, 6032 cog line, wouldn't put us in a bearish bias. I know it might feel that way because we would fall down, but that would just be a part of the wave dynamics, right? It's what markets do. Even if we did fall down to that level, we would still be putting in that higher low. It's not owed to us. We don't have to go down to this lower level. Now that we are above the ADR half and we've tested it multiple times and we still didn't break down through it, we can go to the upper ADR and even go beyond that, even higher. Generally speaking, though, we stay within this range because it's the average daily range. It is the range that the market has developed over the last 21 days, which is a market month. Right? So when we look at a daily chart and we ask what's the common typical range for this market on a day-to-day basis, it's about that much. So if we do today what we have been doing on average, we won't exceed the yellow lines. More often than not, we stay within the red lines. So the base case argument is that we'll come down and work towards getting into this lower level, 6036 or 6032 cog line. That would put us inside of yesterday's range, which right now we're inside day breakout, inside week breakout. I think we're a breakout on the week. Yeah, barely, but hand grenades and horseshoes. If we don't break down through this red line and we continue to push to the upside, one of the things we're going to be focused on was how much farther can we go to the upside. You can measure this distance and plot it higher. That's one more level up. You can also take the entire ADR, 1.36, and you can stack it up. So the easiest way to do that is just mark from red line to red line. So the smaller, darker box here, that's 50% of everything, and then the full box is 100% of everything. 2 more levels up. To get that, we would need significant headline news, right? The market's not going to do that on its own. It doesn't have the juice to do that by itself. We're going to have like some really big wow headlines. The dollar and the 10-year would have to participate. Very likely the Mag 7 would get involved. It would be significant. So it's not going to happen on its own. All right, it's kind of hard to see because everything's buried together. 6039 is today's floor pivot. So far today, we have not hit that floor pivot. It's called an MDP, missed daily pivot. And underneath that, we have 6034, which is the weekly pivot. We are above it, obviously. When you're above the weekly pivot, we're just in a bullish bias. And when you're above a daily pivot, we opened above it, that's bullish. Today's pivot is higher than yesterday, that's bullish. The thing is, the market hasn't hit its pivot point yet, and it generally does. So if we do start to break back down, that is one of the targets. But it's a long ways off, and we have targets to hit between here and there. It is a wide channel. Wide channels imply that if we break out the breakout doesn't stick. So far, we have broke out and it has stuck. But these channels don't make price do anything. They don't make us break out, and if we did break out, they don't make us come back in again. While the move seems like a lot, it's only to the R1. There's a trade strategy that uses floor pivots that talks about going from an R1 to an S2 or from an S1 to an R2. If we break back above our own Globex high, then the R2 is the next target, and then eventually R3. That's a tall order. 62.84, it's a long ways off. The thing is, every once in a while, we get one of these crazy blowout run days where we just keep grinding farther and farther and farther against everybody's odds who say, oh, it's got to turn back at this point. There's no way it'll keep going, and it just keeps going. Look for percentages on those days. So if we make it to 1%, we target 1.5 next. If we get to 1.5%, target 2% next. It may sound odd, but you'd be surprised at how often we get to a solid round percent number before we finally stop moving and even retrace and head back the other direction. At this point, the R1 is the line that we need to break if we're going to continue this move to the downside, and then this pivot that we developed, 61.11 cog line, get through that, begin working our way back down. Otherwise, TRB, get back up to 61.43, get a new Globex high, and continue the move to the upside. We don't have a lot of work up here yet. If we can hold above 6100, we can start to fill this out and see that point of control get moved up. That's a tall order and a big if at this point. We need to keep 6100. I really think that if we drop back down and get a close below it on the day today, then we might not get another chance for a while. So at this point, let's just keep that line in the sand. We've been working on this zone for a while. This is the value area over the last 3 weeks. I kind of stretched it here on the back end the last week. But this is the distribution. So now that we're finally out of all of that trash, that's what we want to keep. We don't want to get back down inside of all of this. And last week when we got into 6100, we put in some work up here. You can see the high volume node. So we made it through all of that, and now we put in some work above it. That's why we need to keep it. If we had just wicked up here and we didn't have anything, you know, hadn't put any work in, you could just drop back down through it, wouldn't even matter. But that's not what we got. $10-day, 30-minute volume profile in TPO. We got a classic distribution at this point. It's kind of hard to see it because everything's scrunched together. But if I was to, reduce the width of the chart here, now you can see more of a classic distribution. everything is wrapped up really tightly in that value area, and we're outside of it. It's really a lot easier to see from here than it is on the last chart that we were on. So we got our level, the line in the sand. We need to keep it the 6,100 that we tested back here that we weren't able to keep. No real discrepancy between the TPO and the point of control at this point, and we're not expecting to see this level move very much either. At the most, it might drop up to 60, 66, but still it would be within the value area that we've already established. We're not expecting it to move anywhere else for at least a week. And since it's underneath this, it's not in the way. We don't care if it doesn't move. And see, I see this profile this morning with TPO in 3 different distributions, and it really makes me consider the idea of the multiple players concept. You know, a lot of times everybody in the market is all doing the same thing. That's where we get that one-time framing sort of pattern, and we're just, nothing but red candles, nothing but green candles. That one-time framing where we just run and run and run and run, and nobody's going in the other direction. And it's because the whole market's doing one thing. If you get something like this morning where you got 3 different distributions like that, and it brings to mind as a reminder that we have competing interests in different groups, and it really stands out on a morning like this. These 3 distributions could all be from the same entity. Could. Very likely, though, that they're 3 different traders, 3 different groups, however you want to visualize it. And it's very likely they're not done yet, too. We did get a new VPOC from yesterday. $60, 66. So if we begin this breakdown back through the levels that we've established last night, then we have that down below. While the push to the upside may seem dramatic, we're not overbought on the weekly. It doesn't owe us any sort of mean reversion, least squared methods. It doesn't mean that we've moved too far too fast, and it doesn't owe us any sort of pullback. We're a bit extended, more than 3.5% above the 10-week, but we're not at the extremes. And so far, it's okay. If we look back at how far away from the 10-week we've been in the past, we've certainly been farther away than this and continued to go even further. So this is fine. We're not in any sort of critical situation yet. If you look at our distance from the 10-day, we are just beyond 1%. 1% above the 10-day is about where we want to be. If we get beyond that, it starts to get a little rough. So we can look back and we can see previous times where we've been above the 1% level on the 10. Certainly we can get into 2 or even 3 and 3.5% before things get to be extreme. So this is not extreme. It's right where we would want to be. Above the 1% and getting into 1.5 or 2%, that's when things start to get a little out of control, but it's not broken at this point. It's not even unhealthy. We're certainly in an acceleration phase. But it's not extreme yet. So we're not looking for any sort of mean reversion or forced reversal back in the other direction. It does start to call into question how much farther we can go. Right? And when it comes to the distance from the 10, the analogy that I've used in the past is a runner going up a really steep hill. So a lot of new traders get hung up on the idea of a fence in the way blocking price from doing something, and that's really the wrong visual. It's much better to think of like a tractor pull scenario or the runner up a hill. So you got a runner running up a steep hill. That would be price getting farther away from the 10-day. The farther they get, the steeper the hill gets. And after such a distance, say 1%, we start stacking weight on the back of that runner. We're not tripping them, impeding them, putting up fences, just putting more weight on them, making it harder to go up the hill. They can still go up the hill. It's just going to take a lot more effort. That's price once it exceeds a certain distance from the 10-day. It can still go higher. It's just going to take a lot more work to do it. So just because we're 1% away from the 10-day doesn't mean anything. We can certainly go higher. They just have to put in more work. We have reached the edge of the weekly expected move. Now, if you remember how we started this week, we talked about how wide the range was for the week because the market was pricing in a good move on the week. It was a wider range by far than we've seen in a while, and we've already reached the edge of it. We were supposed to maintain this range in the entire week. We reached the edge by the end of this, not even the end, by the middle of the second day, right? Because the day's half done already. Yeah, I know for those that just woke up, you might not get that. But the day started last night at 6 o'clock, right? It's past 6 this morning. The day is more than half done. All right, using yesterday's 111 is out of the question. We've exceeded that. So one thing that you can focus on is just using today's Globex, the highest point to the Globex lowest point. There's our mid. You can also focus on using all of what we got in Globex with yesterday's RTH. Now you could use everything that we have from the Globex high down to this low. That would be the range on the week. I know we're only using 2 days because that's all the week has. If this was Thursday, we would do the same thing, use the entire range for the whole week. So you can see if you look at the top, the 111 starts to line up with the 1, 2, 3, 6. They just overlap each other. That would be the Globex high and yesterday's low. Lines up with the 111. And the 1, 2, 3, 6 from the Globex high to the Globex low. The levels overlap because it really doesn't matter how you draw these things as long as you're using the same dynamics, a high, a low, key levels, right? Globex high, Globex low, yesterday's high, yesterday's low. What you find is they'll overlap. So you really can't do it wrong. You still get the lines in the same spot. They also happen to correspond with a big options level, 6150. So it's a big level. It's going to be hard to get through that options level. For something a little closer to home and a little quicker, we are running this reciprocation program right now. So this is the immediate box to GTFO. Get out of this box and begin working on the levels from there. 6111, 6100, 6092, Globex low, half back, on down. Over a 5-day period, the VIX is down over 16%. It's down this morning more than 8.5. Gold and gold miners are down. And energy's down. Not much of a surprise. Yesterday, they said, well, as long as U.S. facilities aren't targeted, it's very likely that crude's going to continue to fall. And then the announcement came out that they were targeting U.S. facilities, and we got that nice spike. That was a perfect short signal. I didn't know how long it was going to take before things started to turn around, so it would have been nice to have used something a little, shorter dated. But within, 2 or 3 hours, everything was done, and crude has started to fall. So the expectation is that crude's going to continue to fall until we get back into our normalized range. Looking at what's up this morning, just about everything else. Communications, growth, biotech, banks, uranium, financials, the Mag 7 itself, industrials, tech, robots, transportation, China, chips, Bitcoin, everything else. At this point, it'd almost be easier just to look at what isn't up or down 0.5% and kind of run from that benchmark. So we got nothing from solar, metals and mining, and really that's about it. Construction, which we should be getting some home data today, some retail, healthcare, so staples. If we're looking for that capital rotation, the 3 on the bottom should continue to lag, and the 3 on the top should begin to improve. The ones in the middle, well, we know energy is going to get whacked, but building materials and industrials, if they tie into the, work being done in the data centers and the new facilities, then sure, they might get a bump. Otherwise, I'd expect the money flow to focus on the top 3. We are absolutely in a risk-on environment. We've got every signal. So what you can do this morning is look for a high correlation coefficient. I know it's really big words early in the morning, but it basically just means that everybody's doing the same thing, right? Take something really simple and big round number like 100. You got the S&P 100 or the NASDAQ 100. Take your pick. You can actually do both. Just detach this page and load it again. So you can make one for the Mag 7, one for the NASDAQ 100. You can do one for the Russell, the Dow, load them up, right? You can do as many of these as you want. But I like to use the 100s because they make percentages easy. Look at how many names are advancing versus how many names are declining. And they won't start working until after the market opens. So advancing issues, you got volume and you got capital. Sometimes you'll get a nice discrepancy between those two. Or you'll get a nice discrepancy between capital and issues. So keep your eye on how many are advancing versus how many are declining. If we get above 90%, that's really bullish. If we get into 97, 98%, you can run something that I call the alpha protocols. The algos can trade baskets of stocks, and over the years I've decided, so what? So can we, right? Of course, you have to make your own basket, but put a basket together. You won't get a 98% very often. So it's not like you're going to be running protocols all the time, but it's nice to run them when you get the opportunity to. We don't have the 98% this morning. We got to get into the open to even see what percent we do have. But looking at the sectors that were up, I would be surprised if we don't have a good 65, 70%. So we're working in the right direction. And it's not always how many names you have, it's what names you have, right? Because, I mean, do you really care that Campbell's Soup is up? Nah, me neither. So this is the NASDAQ 100, looking this morning at how many names in the NASDAQ 100 are up at least a half of a percent. 57. So 57% of the NASDAQ is up a half a percent or more. Yeah, that's a really good start. What names in there, though, are up? So we got some retail trades, specialty stores, internet retail. Some of the Mag 7 are in here. Got a solid semiconductor list. These are the names that we would want to see if we're going to have a rally day. Lots of Mag 7 are in there. The hyperscalers, the market drivers, and they're not alone. Look at the S&P. We have 52% of the S&P more than a half of a percent to the upside. Now you can adjust this to something much smaller, say 0.5%, just to count, well, how many names do we have up this morning versus down? Because that's how the advanced decline is going to work, right? It's only going to look at whether they're up or down at all. It doesn't use a percentage of how much. And that'll give you a feel for how bullish are we going to be opening this morning. And if we were in a very bearish market environment, you could do the same thing on the negative side. So far, everything looks really bullish. And the market does not seem to care about Powell being in the Hill today or the other Fed speakers we have on the table. It all looks to be focused towards the headlines and dollar and bonds and yields. So I would say continue to watch the Mag 7 this morning. Keep your eye on the broader market backdrop with the advance and decline line, and look at dollar yields. We don't even have 0-day flows coming in at this point. Not yet, right? We'll get those once the market opens. And that can be its own driver to where we could get into 6,200 by the end of the day. We don't need to do that, right? It doesn't need to be that extreme. And we are already at the ADR half on the upside. So going to the other side would put us back inside of yesterday's range. Just so that everybody understands, I'm not just talking bullish here. We could get back to 60-50 by the end of the day today. Unusual Whales just posted that the CEO of NVIDIA started selling stock. This is sale that's a part of the new 10b5-1 plan adopted in March. He sold 100,000 shares over a 2-day period. Made almost $14.5 million. Nice for him. So a little insider selling on NVIDIA. All right, guys, that's what we got. Short and sweet. GTFO, get out of the box, play the levels on the way down, and or break Globex high. Measure the levels up as we go. Aim for 6150, and if we get above that, that puts 6200 on the table. Be careful. Be safe. I'll see y'all tomorrow.